As of the most recent market close on July 7, 2026 at 4 p.m. Eastern Time, Datavault Inc., trading under the ticker symbol DVLT on the Nasdaq Global Market, finished the regular trading session at exactly $0.3518 per share. This represents a decline of 3.67%, dropping about $0.0134 over the course of the day from its previous levels. While a daily swing of a few pennies might seem minor for a larger equity, for a microcap asset struggling in the sub-dollar territory, this movement reflects an ongoing grind down from its 52-week high of $4.10. If you look closely at what happened immediately after the bell, the after-hours action saw some thin buying that bumped the asset up slightly to around $0.3541, but the core reality remains that the market is showing intense skepticism toward this company. Most retail market participants who load up their mobile software looking for high-risk, high-reward penny plays see this as just another cheap tech play attempting to ride the massive coattails of giants like Nvidia stock. But the real story that the broader public is completely missing right now is the sheer absurdity of the company's recent strategic pivot, which culminated in them distributing a cryptocurrency token called the Dream Bowl AI meme coin to their own stock investors. Think about that for a second. An enterprise that claims to be building institutional-grade data tokenization systems and a quantum-ready edge network is actively launching a meme coin on the Biconomy exchange under the Dream1/USDT pair to reward its shareholders. Management frames this as a brilliant method of digital engagement, but institutional operators look at a move like this and wonder whether they are analyzing a serious financial infrastructure company or a speculative internet project. This bizarre duality creates an immense disconnect between what the retail crowd expects when they see an artificial intelligence sticker slapped on a corporation and the actual balance sheet reality. The common ground among small-scale market participants is that any company working within data monetization and edge computing must have an immense runway for growth. If you browse through popular retail investing sites or check trending assets on the Robinhood app, the general narrative surrounding Datavault Inc. centers on a massive turnaround. Investors look at management's reaffirmed full-year guidance for 2026, where the executive team is confidently projecting a revenue target of at least $200 million. For a company currently trading at 35 cents, a $200 million top-line run rate would imply that the asset is severely undervalued, especially since its market capitalization sits right around $103 million. Retail participants use self-investing accounts to accumulate shares, believing they are getting in on the ground floor of a massive corporate evolution. However, the contrarian view, backed by a cold assessment of the numbers, reveals a deeply troubled financial engine that is burning through cash at an alarming rate. When Datavault Inc. reported its first quarter financial results for 2026, they did manage to beat analyst expectations on the bottom line, reporting a net loss of 9 cents per share against a consensus forecast of a 14-cent loss. On paper, a 35% earnings surprise looks phenomenal, but look at the actual mechanics of that report. The company generated just $3.42 million in total revenue for the entire quarter. Even though that is a massive percentage increase compared to the prior year's meager $0.6 million, nearly all of that expansion was driven by the acquisition of a legacy business called CompuSystems. Meanwhile, the sales and marketing expenses skyrocketed to $6.6 million for those same 3 months. When your quarterly marketing budget is double your total quarterly revenue, your business model is not scaling efficiently. It is being propped up by intense promotional spending. This deep operational deficit explains why the market reacted so violently to the earnings beat. Instead of rallying on the positive earnings surprise, the shares collapsed by nearly 15% in the immediate aftermath of the announcement. Smart money look at these dynamics and realize that hitting a $200 million target by the end of December is an incredibly steep hill to climb when your first 3 months only yielded $3.5 million. The institutional volume has been incredibly thin, and much of the daily trading churn is driven by short-term traders using the Robinhood trading feature or searching for high-volatility microcaps on the SoFi active investing interface. When big asset managers look to allocate capital through a structured investment tool or an individual brokerage account, they look for predictable, recurring revenue streams, not speculative promises tied to unpassed federal legislation. Comment below how many shares of Datavault INC you currently hold in your portfolio, or if you are entirely avoiding this asset class right now. To truly understand how Datavault INC landed in this position, you have to look at its trading history over the past year. The stock has been a battleground between optimistic retail buyers and aggressive short sellers. In October of last year, a major short-selling research firm named Wolfpack Research issued a scathing public report on the company. The report alleged that the corporation was essentially a promotional vehicle operating on empty assertions regarding decentralized ledgers, artificial intelligence, and data valuation. They pointed out that despite the grand announcements of massive data contracts, the actual transaction volume on the company's blockchain architecture was virtually non-existent. The immediate fallout from that report was brutal, causing the stock to tank nearly 15% in a single afternoon, plunging from above $2 down into the penny stock depths. Even though management pushed back against the claims, the reputational damage stuck, and law firms like Pomerantz LLP are still actively investigating whether the corporate leadership engaged in securities fraud or misleading market communications. This cloud of litigation and skepticism has forced the company to take drastic measures to survive. Just a few months ago, the corporation had to execute a $60 million registered direct offering of common stock. While adding capital to the balance sheet is generally good for liquidity, issuing tens of millions of new shares at a steep discount completely flattens the upside for existing retail holders who bought in at higher levels. This dilutive financing brought their total working capital up to roughly $140 million, giving them a temporary lifeline to build out their edge network. But when a firm relies on dilutive share printing rather than organic cash flow from operations to pay the bills, it places an artificial ceiling on any potential rally. People who use interactive brokers stock trading to short the asset recognize that every time the price tries to pop, the overhang of newly issued shares and potential warrant conversions flattens the upward momentum. If you peel back the layers of the corporate identity, the business model itself has undergone a total transformation. The entity was originally known as YSAW Technologies, a hardware-focused business specializing in wireless audio spatial design and sound systems for home entertainment. In February of last year, the company chose to completely rebrand to Datavault INC, shifting their entire marketing focus from consumer electronics components to advanced digital infrastructure. The core of their current pitch revolves around a patented platform called Datavault, which is designed to help enterprises index, secure, and monetize their proprietary corporate data. The business logic states that companies sit on massive mountains of unutilized data that could be structured and sold to train artificial intelligence models. To accelerate this transition, they have recently announced plans to spin off their legacy acoustic division, allowing the remaining corporate shell to focus entirely on building dedicated data tokenization exchanges like NIAX, the Intellectual Property Digital Exchange, and the International Environmental Exchange. The success of this entire operational pivot depends heavily on factors that are completely outside the company's control. Management has openly admitted that their ability to recognize nearly $100 million in projected contract fees later this year is heavily contingent on the passage of a specific piece of federal regulation known as the Clarity Act. If the government fails to pass this legislation or alters the regulatory framework for digital asset tokenization, Datavault INC's projected pipeline could evaporate almost instantly. This creates a massive risk profile that makes the asset highly unsuitable for traditional online investment portfolios that prioritize stability and risk mitigation. When you look at the landscape of online investment alternatives, the contrast becomes even sharper. Traditional platforms offering investment help or structured index products like Schwab Intelligent Portfolios rarely touch equities with a weak financial health rating. Analytical frameworks rank Datavault INC with an exceptionally low operational health score because of its negative profit margins, which have historical dips below -200%. If you are handling your own assets via a Fidelity